The September jobs report just came in, and the headline number 263,000 jobs were created in the United States for the month of September. Here we go on BLS.gov. Payroll employment increases by 263,000 in September, and the unemployment rate edges down to 3.5%. So let's dig into these numbers just a little bit. First, we're switching over to trading economics now, and here you can see the U.S. unemployment rate currently at 3.5%. Now, we were at 3.5% back in July. We ticked up to 3.7 in August, and that had some people thinking the Federal Reserve was about to get what they wanted, higher unemployment. Well, that ticked right back down to 3.5 for the month of September. So this means a more aggressive Fed is on the horizon, and that's going to have investors spooked this morning. The U.S. unemployment rate fell to 3.5% in September, matching July's 29-month low and coming in below market expectations of 3.7%, in another sign overall labor market conditions in the world's largest economy remain tight. Now, switching over to labor force participation rate, this is the percentage of people who are actually working, and the labor force participation rate in the U.S. edged down to 62.3% in September, down from the 62.4% in the previous month. Now, again, that tick up in workforce participation rate last month, that was a sign that the Fed's tightening was starting to have the desired effect on the economy as more people were forced back into the workforce for economic reasons. So to see that number ticking back down this month, not such a good sign. Again, this is another indicator that there is a more aggressive Fed coming, and investors won't like that. And now here we are looking at the actual non-farm payrolls. The U.S. economy added 263,000 jobs in September, the least since April of 2021, but above market forecasts of 250,000. Notable gains occurred in leisure and hospitality. Those are some of your lower wage jobs, and in healthcare, while big job gains were also reported in professional and business services. And you can see here in this chart down below, this is the number of jobs added per month, currently at 263. Now, that is down sharply from some of the prior months, but again, still above market forecasts and still a sign that supply and demand in the labor market are out of whack, at least according to the Federal Reserve. And when supply and demand are out of whack, when there is more demand for jobs than there is supply, prices go up. Prices going up, well, that is your wages, and we can see that in this chart. United States average hourly earnings month over month for all employees rose by 10 cents or 0.3% for the month of September to $32.46. Now, again, this chart is showing the month over month increases in wages. This is the raises that you're getting on average, 0.3% for the month, slightly below what we've been averaging for the last couple of months, but still a tick upward. Now, one of the things the Federal Reserve is worried about is something that they call wage spiral inflation. It's not something I'm so worried about, but the Fed definitely is worried about. They're afraid if you make more money that you're going to spend more money, and you spending more money is going to cause more inflation. And keep in mind, the whole reason the Fed is raising interest rates and doing quantitative tightening right now is to try to keep inflation down, and it's not really working. And the fact that wages are still rising and we're still adding so many jobs, that means the Fed is going to keep at it for longer. And what does this look like on a year-over-year basis? You can see that in this chart. United States average hourly earnings year-over-year. This compares what people made in September of 2022 to what they made in September of 2021. And those increased 5% in September, which is down from the 5.2% increase in August. Now, keep in mind, this is a year-over-year increase, so any positive number means wages are still rising. But I would point out 5% year over year, that is well below the headline inflation number, which was 8.3%. So when inflation is higher than wage increases, that means the average person's life is getting more difficult. That is more economic hardship for the average person in the United States. That's one reason I'm not so worried about wage spiral inflation like the Fed is. When people's wages are rising slower than the rate of inflation, that means people are getting poorer, and poorer people don't rush out and spend more money on consumer crap. And you also need to keep in mind that the headline inflation may be 8.3% over at the Bureau of Labor Statistics. But if you're like me and you go by what John Williams, shadowstats.com says, where he uses the same methodology to calculate inflation that they used back in the 1970s, that shows inflation is actually closer to 18% year over year. So again, this is severe economic hardship being inflicted on people. Their cost of living is going up way faster than their income. But it is this chart here, the 263,000 jobs added for the month of September, and this chart here, the 3.5% unemployment. That's the one that markets are going to be worried about this morning. and those indicate more tightness in the labor market, which means more upward pressure on wages, and that has the market worried that the Fed is going to keep slamming on the brakes in the economy, and you can see that in stocks this morning. Since this jobs report came out just a few minutes ago, a big red candle down. The Dow is currently set to open down 250 points. See the same thing on the S&P, big red candles down, currently set to open down about 1.17% or down 43 points. And the NASDAQ leading the way lower, 188 points or 1.63%. So stocks are not liking this jobs report. So depending on how you look at it, this could be a good thing or this could be a bad thing. It's a good report because the unemployment rate went down and more people are working. That is generally considered a good thing. Wages went up 5% year over year. That's generally considered a good thing. But it's a bad thing if you consider that additional tightness in the labor market means a more aggressive Federal Reserve, means they're more likely to continue tightening and cause some kind of problem in the financial system. And it's also not a good thing that people's wages are rising at a rate well below the rate of inflation. That means people's lives are getting more difficult. And if you want to know more about why I think Jerome Powell is working so hard to make sure you do not get a raise, you can check out this video I made a few weeks ago about how J. Powell is trying to kill the jobs market. Till next time, live small and dream big.